As 2015 concludes, it's important to discuss investment strategies for next year. While some believe the Federal Reserve will aggressively raise rates 3 or 4 times in 2016, I believe this scenario is unlikely. In January 1994, the consensus was for solid consumer and business confidence growth. This happened too. The gross domestic product was expected to grow at 3%, low inflation of 2.7%, and unemployment was less than 6%. The economy was generating about 275,000 new jobs monthly. U.S. manufacturing was rising to almost 16%, while Japan and Germany's were declining. The Federal Reserve raised rates 6 times that year to put a lid on inflation. What happened is that the steep rise killed the bond market, which at the time included lots of derivatives. How do things look by comparison now? Well, consumer and business confidence have declined steadily in 2015. GDP is expected to grow around 2%. Inflation is less than 0.5%, and unemployment is 5%. The economy is generating around 200,000 new jobs monthly. U.S. manufacturing has been rising since 2009, albeit only 12%. Another interesting comparison is that of money velocity. The chart on the screen shows the velocity of money going back to 1959. The velocity of money is the number of times $1 is spent to buy goods and services per unit of time. If velocity is increasing, as it was in the 1990s, then more transactions are occurring between individuals in the economy. In other words, this is an excellent way of visualizing how quickly money moves through the economy and if businesses and individuals are spending more or saving more. As you can see, velocity is now at the lowest point it's been in 56 years. In summary, things in 2015 look much bleaker than they did in 1994. Hence, my position is that interest rates ought to remain unchanged, or probably just one increase of 0.25% later in the year. What does this mean for fixed income? The relative steadiness of interest rates will be great for these investors. Also, the issuance of Treasury notes and bonds is projected to fall to its lowest level since 2008. This is because Congress is focused upon reducing the federal deficit, issuing mainly short-term credit. The reduced supply, but growing demand for secured debt instruments ought to cause the values of existing bonds to appreciate, thus flattening out the yield curve. Bondholders ought to see appreciation of principal and a steady income stream. Closed-end bond funds that currently trade at a discount look particularly attractive now. Once the world realizes that the Federal Reserve is not going to raise rates steadily next year, the U.S. dollar ought to pull back, which would propel equity and gold prices. A Republican presidential win might correct any dollar inflation, so my predictions for equities and gold would be mid-single-digit returns. There will be exceptions, though. My favorite equities continue to be Amazon and Apple. I expect both of these stocks to advance well beyond 5%. In the case of Amazon, it is the 21st century Sears and Roebuck catalog. The company's expansion potential and execution is amazing. In fact, Amazon alone will take about 51 cents of every dollar of all e-commerce growth for 2015. Staggering, isn't it? This can largely be attributed to its immensely popular $99 a year Amazon Prime service, which offers free 2-day shipping for members, along with unlimited streaming television, movies, music, and access to over 800,000 free ebooks. 25% of all U.S. households have already signed up for the service, and this number is expected to double over the next 5 years. As for Apple, the synergies associated with Apple Pay and other network-type businesses ought to begin to surprise investors late in the year, giving shareholders a nice boost. The future looks bright for Apple. If you have any questions about your portfolio, give us a call at Armada Advisors, where we are charting a better course. Happy New Year.